Hi everyone, I'm James and I'll be conducting this webinar starting now. So I hope all of you can hear me well and you all are doing well as well. Happy New Year. Welcome to Talk Stocks with James series. Tesla stock had the worst year ever. Where could it be headed next? Just give me a second. Okay, I would like to remind you that this webinar is conducted on every alternate Thursday, 7:30 p.m. The next one will be 2nd February. And yes, we are uploading our webinar on our YouTube channel. If you miss out any one of our webinar, we got you covered. The replay will be available on YouTube. So look out for that. Let me begin with some disclaimer first. This presentation is for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of future performance. And this is a speaker profile. I'm James, Market Strategist at uSMART Securities. I'm also a SGS Academy speaker. Recently, I did a lot of interviews on 联合早报. So if you see 盈利证券市场策略师黄家人 on 联合早报, that's me. And anyway, if you have some questions about the market, you're welcome to reach out to me on our uSMART app. Just click on the Learning tab and you can find my chat room here and type your question into the chat room. When I see it, I will answer as soon as possible. And currently, uSMART Securities would like to reward new customers who listen to this webinar with USD $2. If you still a new customer and have not yet deposited money into your trading account, please type in your uSMART account number in the Q&A box. I will then provide your account number to my back end to verify and transfer the cash voucher into your trading account. If you cannot remember your uSMART ID, it's okay. You can also provide me your email, your handphone number in the Q&A box in this Zoom webinar. So what you type into the Zoom Q&A box will not be shown to others, so do not need to worry about that. Today, I will conduct this session differently. I will not provide any US market outlook. I will just focus on Tesla stock due to time constraint. Mainly, I will share about the electric vehicles sector's outlook and then zoom in on Tesla. The most important question here is, where is the bottom for Tesla? Now, let's talk about the most exciting stock in the world, Tesla. Tesla share price fell 65% last year. It's the worst performing year for Tesla since listed in 2010. According to Bloomberg consensus, currently 27 analysts recommend buy, 13 recommend hold, and 6 recommend sell. The upside potential is 50% with a target price of $193. And let me run through the industry landscape first. There are 3 important things you need to know about the EV market. Firstly, the total addressable market. Here shows you the global EV sales and market share from 2010 to 2021 by IEA. I think 2022 data will be released at the end of this month. So this chart itself is a bit outdated, but basically here show you that there are 6.6 million EVs sold in 2021, a jump of 120%, and 9% of the global car sales today is electric vehicles, which means every 10 car sales, 1 is electric vehicles. EV is still in the early growth stage. And there is a magic number you need to remember, and that is 5%. When a country crosses 5% market share threshold, it signals the start of mass EV adoptions. Meaning to say, once the EV adoption rate is more than 5%, you should see fast adoption of EV in that country. And US is now the latest country to cross 5% in 2022, along with other 18 countries cross the 5% magic number I think we should start seeing good adoption rate of EV. Secondly, I think the electric vehicles will become cheaper, but still cost you more in total due to monthly subscription fee. To put it simply, the normal car that runs on petrol, gasoline will cost you a lot in terms of the petrol charges, but people like EV because electric cars are still cheaper to run than petrol and diesel. The charging fees you spend on EV could be 60% to 70% less than you spend on petrol. And for an EV maker, since you are no longer, since customer is no longer spending money on petrol, they want you to spend on other things. They want you to spend on software and subscription fees itself. So in future, the total cost you spend on an EV could be more than you spend on a normal gasoline car. For example, Tesla is charging $15,000 on his autonomous driving system, FSD, full self-driving subscription, and the subscription fee is getting more expensive. It has increased 300% in 4 years' time. Other subscription fees include acceleration boosts. If you want to go from 0 to 60 miles per hour in 4.3 seconds on your Model Y, which is an improvement of half a second, you need to spend $2,000 on the acceleration boost itself. Other than that, you can spend a monthly subscription fee of $9.99 on its connectivity package to enjoy things like live traffic visualization, satellite map, and internet browser as well. All in all, it sounds like a software as a service company. Investors don't look at Tesla as a car company. They look at Tesla car as a piece of technology. This is why they apply a technology stock valuations on Tesla. Lastly, TAS, Transport as a Service. By 2030, we think X expects 95% of all passenger miles traveled will be made in on-demand autonomous EV owned by fleets, but not individual people. Meaning to say, when you travel between point A and point B, you will be taking an autonomous self-driving vehicles. Your Tesla car will drive you to work in the morning and pick you up from work later, but in between, it will pick up your children from school to tuition center in the afternoon and charge itself in a charging station. To me, this is still a distant future, but I think the real race between all the EV makers, all the EV players around the world is in autonomous driving. Who can make the first true transportation that goes from point A to point B with zero human intervention under any road conditions? There are two approaches on autonomous driving, a pure vision approach and LiDAR. I do not want to go into a huge debate on which is better, Tesla, FSD, or LiDAR. Why other major players are using LiDAR, whereas Tesla is the only player using FSD. I will leave it to another day. But very quickly, 3 points I want to make here. Number one, LiDAR is really costly. This is why Waymo, which already reached level 4 autonomy, can only run on certain cities. Number two, the best bet could still be Tesla, considering the number of cars running on the roads, sending back road data to Tesla AI to process to come up with a better autonomous driving platform. FSD technology is probably 3 to 4 years or maybe 5 years ahead of other autonomous driving system. Number three, since no one knows which autonomous driving system is the best now, the stock market won't say FSD will confirm fail and punish Tesla in stock prices. Or I should say, no analyst will fit FSD into their valuation model and give Tesla a premium or discount now. Now let's focus on Tesla. Let me answer one commonly asked question first. Why Tesla dropped 65% in 2022? Firstly, you need to blame it on higher interest rate. Higher discount rate in valuation model causes lower multiples, lower valuations, and higher borrowing costs will stop people from buying expensive items like EV as well. Secondly, the Twitter acquisition really messed investors up. Tesla investor thinks Elon Musk won't have time to manage Twitter, but Elon Musk already said that he expects to reduce his time at Twitter and step down from the Twitter CEO role. And investors are also worried that Elon Musk will continue to sell more Tesla shares to fund Twitter. In 2022, Elon Musk sold about 59 million shares of Tesla in total, worth about 23 billion. Elon Musk still owns roughly 424 million shares, excluding the stock options. He is still the top shareholder with 13% holdings in Tesla, which means he only sold about 12% of his Tesla shares in 2022. And if he decided to sell some Tesla shares to do something he likes, in this case, which is to fund Twitter, I would say it is really not a big of a deal. Thirdly, there was supply problem in 2022, and this year investors are worried about a demand problem. I will explain more later. Now let's go back to Tesla fundamental. Tesla is an electric vehicle company. 87% of the revenue generated from EV, and it also sells solar energy system, energy storage devices as well. This accounts for 8% of the revenue. Other services account for 5% of its revenue. Let me spend a few minutes to talk about energy storage and other services first. Let me get this out of the way before we jump into the main revenue contributor. In the recent quarter, there is a significant increase in the energy storage deployment, which increased by 62%, and solar deployment increased by 13% year over year, which is one of the strongest quarter. And because of that, the energy generation revenue increased by 38%. We could also see that other services increased by 12% year over year. Quite a prominent increase, but it is only contributing to 3% of the gross profit. So it is still quite small. It is negligible. Let's go back to the automotive segment, the main revenue contributor. Under the automotive segment, Tesla currently has 4 electric vehicles models, namely Model S, Model 3, Model X, Model Y. Together, they are Model Z. From the selling price itself, we could see that Model S and Model X are high-end vehicles. Model S and Model X are sedan and SUV respectively. From the deliveries numbers, you could see that Tesla is not focusing on Model S and Model X. They are not even available in some countries as well. And Model 3 and Model Y are having lower, more affordable selling prices at 40 to 50,000 itself. And they are sedan and crossover respectively. Currently, Tesla focus more on Model 3 and Model Y. They account for 95% of the Tesla car deliveries. Tesla is one of the most powerful brands in the world. Tesla is ranked as the 12th best global brand with a brand value at 48 billion. In terms of automotive brand, Toyota and Mercedes-Benz are ranked in front of Tesla, taking the 6th and 8th spot among the best global brands. There are a few key numbers that every Tesla investor is looking at. They are production and deliveries and market shares, profit margin. Let's talk about the deliveries number first. And when looking at the number, we need to answer one critical question. Does Tesla have a demand problem? Recently, a lot of people are selling Tesla shares because they think that Tesla is having a demand problem. Because in early 2022, Elon Musk said that they will hit 50% growth in both production and deliveries numbers. However, at the end of 2022, production growth in 2022 only increased by 47%, slightly below 50% target, and deliveries only grew by 40% year over year. Both missed the 50% growth guidance. Is that really a problem? I don't really think so. Because if you were to look at the 50% growth target when Tesla first shouted out to investors in 2021, they say that they will achieve 50% average annual growth over a multi-year horizon, which means in some years they may grow faster, in some year like 2022, they grow slower. So it's completely okay to grow only 40% in 2022. And if you draw a 5-year chart and look at the 50% growth guidance over 5-year horizon, we should expect Tesla to reach near to 4 million cars in 2025. And based on the guidance, because 2021 is a fantastic year in terms of both production growth and deliveries growth, and even 2022 disappointed all of us, both productions and deliveries are still above the guidance itself. And some investor will also look at the difference between productions number and deliveries number and say that Tesla has a demand problem because the difference is just getting larger. But I'm not exactly worried because if you take the difference of the productions and deliveries and then divide by the production number, it tells you that the not yet delivery units just account for 4% of the productions in 2022. So it is not exactly a big number per se. In any case, Tesla recently cut car prices worldwide, and it should help with the inventories problem. As we can see, the inventory level has been reduced by 71% since January 12th. Then investors again say that Tesla realized that it got a demand problem, so it cut prices worldwide. I think Tesla cut prices due to many reasons. It is cutting price to help to pump up sales for sure. But in US, to me, it is cutting price in order to be eligible for the 7,500 IRA credit. Because initially, only Model 3 RWD rear-wheel drive and Model Y 7-seaters enjoy the 7,500 tax credit. So Tesla purposely cut prices 15% to 20% in other models in order to bring car prices to be below 55,000 to be eligible for the tax credit. This is why Model 3 Performance and Model Y Long Range AWD are enjoying the 7,500 tax credit now. And since 2021, Tesla car prices has gone up a lot as well. So even with the price discount now, most of the cars are still higher than the price in 2021. I also reckon that it is probably best for Tesla to cut its prices to the bone, to the lowest possible amount at one go. Because if Tesla doesn't cut prices at one go, Tesla car buyers will wait until Tesla cut to the lowest and then start buying. And I think cutting prices to sell more cars is not a sudden plan. Tesla is cutting prices to fulfill its initial mission statement. Because way back in 2006, Elon Musk has revealed that his secret master plan is to build an affordable car. So if the profit margin is strong, free cash flow is good, you are the market leader, and this year the world has a higher possibility to go into recession. You have weaker players like Rivians and Lucid Berry surviving, in which they have a higher likelihood of going under. So Tesla may be cutting prices to put the competition out of business. Because if not now, then when? The next most important thing investors are looking at is market share. There are two extremely important markets for Tesla, United States and China. In US, Tesla still dominates the EV market in third quarter 2022, according to Counterpoint Research. Tesla Model Y and Model 3 are still the best-selling EV in US, and Tesla brand has the largest market share of 48%. In a separate research by S&P Global, in the first 9 months of 2022, market share is 65%, down from 79% in 2020 and 71% in 2021. And S&P Global predicts that it will drop below 20% by 2025. I will tell you if declining market share is a concern later. In China, BYD has the highest market share by volume as well. BYD sold 1.8 million EV in 2022, making up 31% market share, whereas Tesla sold 439,000 EV, making up 7.8% market share. And if we look at global sales, BYD owns 19% of the market share. Tesla only has 12% market share. It seems like Tesla is no longer the market leader by car volume, and the market share keeps shrinking. But I want to tell you that shrinking market share is not a huge concern. Because number one, the entire market is still growing. And with many new EV makers joining the EV market, it is natural to see the market share shrink for Tesla. Secondly, market share is never a big concern for Tesla because BYD is selling their cars cheap. So they can sell more cars, but the profit margin is low, making BYD not so profitable. And Tesla is still the most profitable EV maker. For example, let's look at handphone market. Apple is not ranked number one in terms of market share by global smartphone shipment. Apple just owns 13% market share, losing out to Samsung. but Apple capture 75% global handset market operating profit. Apple garners 66% more operating profit than Samsung. Why is that so? Because Apple is selling iPhone at a higher price. The operating margin is higher. So it will be the same case for Tesla in the EV market as well. So that brings us to my final point. Tesla has good profit margin. We could see that Tesla gross margin has improved from 18% in 2018 to 25% in 2021. And in the recent quarters, it has once hit 29% gross margin before coming down to 25%. Operating margin has also improved a lot from negative 1.8% in 2018 to 12% in 2021. And the recent quarter operating margin is 17%. And we could see that from the graph here, Tesla is having the best gross margin among all car makers and EV makers, and having the best operating margin among all players as well. This is why I say that I'm not concerned about declining market share, because Tesla cars can sell at a higher margin. You can see traditional car maker like Mercedes, GM, Toyota, Volkswagen are having lower operating margins than Tesla. And if you really like traditional car maker venturing into EV business, my question to you is, if these old car makers are not able to elevate their operating margin for the past many years, what makes you think that they are able to succeed now in the EV business? The operating margin for Tesla is still quite high at 17%. And since Tesla is lowering the car prices worldwide, I think the profit margin will be lower in the next few quarters. Personally, I think the gross margin and operating margin in my worst case scenario will be maybe 10% or 20% lower than current levels. And I think that Tesla might be testing investors' comfort level and decide which profit margin level is comfortable enough for investors without bringing down the share price much. So the next few quarters are quite critical. Here I want to show you the revenue by some of the new EV companies. We could see that Tesla generated the largest revenue and BYD is the runner-up. So investors might be excited about BYD and think that BYD can grow bigger than Tesla one day. Other new EV makers like Lucid, Rivian, Li Auto, NIO are all struggling. I also want you to look closely at operating profit as well. Basically, if you look at operating profit, Tesla blew the competition out of the water. From the operating profit of BYD, we could learn that the cars are not that profitable, which means if you measure market share by all the EV maker operating profit, Tesla will be the one having the largest market share. And you should probably be worried about smaller players like Rivian, Lucid, NIO, Li Auto, or Xiaopeng as well, if they really could survive. And you should really get excited about Tesla other projects as well, because it could provide good revenue stream to Tesla in future. Number one, Cybertruck. Cybertruck is a pickup truck, and pickup truck is popular in US. The chief designer recently said that is near productions. It expected that Tesla will start car delivery in the second half this year. It is estimated Tesla has more than 1.6 million customers placing the $100 deposit for the truck. Considering there was 1.3 million Tesla cars produced in 2022, if all this new 1.6 million customers go through with their Cybertruck orders in the next few years, the existing orders of Cybertruck will keep Tesla super busy for some years down the road. Number two, Tesla Semi. Elon Musk said that 50,000 units will be produced annually in 2024. At least that's the target for 2024 in North America. But in 2023, most likely the production target is just 100 semi trucks, of which most of these 100 trucks will go to Pepsi Cola first. Number three, Tesla Bot Optimus. Elon Musk also predicted that the Optimus will be ready within 3 to 5 years for less than 20,000 and say that it will transform civilizations. I am not exactly convinced about the timeline he gave, but if it really succeeds, it could really change the business model for the Tesla company entirely. Lastly, we also want to take cues from other fund managers as well. Probably we want to look at some other prominent funds that are buying Tesla. They are ARK Invest by Katie Wood and Barron Funds by Ron Barron. Currently, Tesla is the top holdings in their portfolio. Tesla accounts for 7.5% in Katie Wood's ARK Invest portfolio and accounts for 15% in Ron Barron portfolio. In any case, ARKK ETF by Katie Wood crashed and burned in recent years and is still burning. So probably it's better that we learn from other investor, growth investor like Ron Barron. His fund currently has the highest percentage of overall portfolio allocated to Tesla, with 15%. He has started buying Tesla since 2014. He is a buy and hold investor, but unlike Warren Buffett, Ron Barron likes to buy and hold growth stocks like Tesla. He will look for companies to grow at a faster than average rate, and he would like to invest into the business in order to double his money every 5 or 6 years itself. And in the recent interviews, he said that in 10 years' time, Tesla will be the largest and most profitable company in the world. Tesla, which was worth 607 billion in October when he conducted that interview, he said that it will reach a valuations of 4.5 trillion. And if Ron Barron is right about the 4.5 trillion valuations, it means that investing in Tesla share today at the current price, I believe it will be near to $130. It will give you 11 times return in 10 years' time. In conclusion, I am optimistic. I'm staying constructive on Tesla. Tesla has dropped 65% in 2022. 2023 year to date is up 4.5%. But if you really think that it could go down some more, I also want to present you the option to short sell Tesla. If you really hate Tesla that much, dislike Elon Musk and think that Tesla share price could go down some more, you could use the short selling function here at uSMART Securities app to short sell Tesla. But over the years, I've seen many analysts say bad things about Tesla, and gave Tesla a sell rating. But Tesla has proven them wrong time and time again. So probably don't bet against Elon Musk. But if you really think that it's going down, it could go down to probably $108 or $90. Or in my worst case scenario, it could even go down to $52 if the market panic. In other words, if you are a buy and hold investors, probably all these support levels could be hit in the first half of the year. You could probably pace your entry by placing your investment at these support levels. It may come down in the first half of this year. But at the current price, $128, I don't think it is expensive. Meaning to say, if you are looking at a time-year investment horizon in Tesla, the current price level is really looking attractive. If you have already invested in Tesla lately, if you are just a short-term trader, then I probably like to share with you that my next meaningful resistance level is $152. But if you like Tesla like me and like the investment thesis I presented to you and have not yet invested in Tesla, then I would say that Tesla looks attractive now in terms of valuations. But again, you also need to understand that Tesla is another kind of animal. The maximum drawdown was 73% over a 10-year period, larger than NASDAQ, 35%, larger than S&P 500, negative 33% as well. And if you already own some Tesla stock, you probably would ask if now is a good timing to average down. My answer to you is that you really need to look back at your portfolio exposure in Tesla. To me, I would say that 10 to 15%, 1.5 exposure in Tesla is good enough. Personally, no matter how optimistic I am of Tesla, I would personally say that one of the better portfolio construction method is not to risk more than 10% or more than 15% in a single stock itself. And and I continue to have strong conviction in Tesla. EV industry is still one of the best growing industry for growth investor. And if you want to gain exposure in EV industry, Tesla is still the best player out there. I know a lot of you are trying to find the next Tesla, are trying to find a car maker that is better than Tesla. To me, my answer is that why you want to find the next Tesla when there is already a Tesla in the stock market. Okay, so that would be all. And then we are also running an interest reward promotion as well. If you have some idle cash, you may want to participate in this interest reward promotion to enjoy up to 4.6% per annum interest. The promotion is available for USD and Sing dollar. The minimum deposit amount is 500 USD and 2,000 Sing dollar itself. The login period is 6 months for USD and 1 month for Sing dollar. Basically, you need to submit your interest in our app before end of this month to partake. And it is really easy to join. Just go to your uSMART app, click on the banner on top of your app, and then you can find all the information there, including the step-by-step guide itself. Okay, so that would be all from me. If you have any question, please type in to the Q&A box and I will answer one by one. Okay, I have my first questions. So, what about China car makers? What do you think of Li Auto and Xiaopeng, NIO, BYD? Thank you. Okay, that is a good question, and my answer to that is probably a bit long. In terms of China automaker, I only like NIO and BYD, but not Li Auto and Xiaopeng. The main reason I don't like about Xiaopeng is it is targeting low-end customer by launching the low-end model. So basically, if you are targeting low-end customer, your profit margin is low. And normally, I don't like low profit margin company. And recently, we also heard the news that Xiaopeng is cutting their car prices as well. I think it is in response to Tesla cutting prices. So it could be interesting to see how long can Xiaopeng keep up to Tesla cutting prices. I don't quite like Li Auto. I think Li Auto at this moment is offering hybrid car, but not pure battery car, and hence is not and hence even if it is targeting the high-end customer like NIO at the moment, and we could also see that Li Auto profit margin is okay, it's quite high. It's only to achieve the high profit margin on his hybrid model. I probably would like to wait until I see Li Auto start launching pure battery car and reassess if Li Auto can achieve the same high profit margin before deciding to put my money into that. On the other hand, let's talk about NIO. I like NIO. NIO is a pure EV car maker, is targeting high-end customer with his premium model. I also like his battery swapping concept as well. Yep. And in terms of BYD, Warren Buffett still owns a sizable amount in BYD. So if you like Warren Buffett, BYD can be considered and value investing for you, but now Warren Buffett is slowly selling away. Nevertheless, BYD is selling more cars than Tesla now globally. And I also like BYD blade battery technology. All in all, I think the problem for China car makers, of all the names that you mentioned, is since now Tesla has substantially lowered its selling price in China, so most China car maker may also need to lower their prices in order to compete with Tesla, and hence we may see lower profit margins for all of these car makers. In short, I think NIO and BYD are okay, but I still prefer Tesla. If you are unsure and still want to gain exposure to China EV maker, one of the better ways is to invest in China EV ETF, like Nikko AM China EV ETF. I can't remember the full name off the top of my head, but it is a good ETF. We should not only gain exposure to all the Chinese names you mentioned, you can also gain exposure to Ningde Sidai, which is CATL, the battery maker as well. Okay, so let's move on to other questions. Okay, so what about the US new EV makers like Rivian and Lucid? Will they pose a threat to Tesla? I think more and more investors are predicting either Rivian or Lucid may not survive 2023. Jokes aside, I think the main attraction for Lucid is it is an EV startup that spun out of Tesla. It was founded by the former Tesla executive Peter Rawlinson. He was the engineer for Tesla Model S. But Lucid may be in trouble. They missed their earnings estimate and their delivery estimates in their recent quarters. And I think the guidance for 2022 delivery is quite low at 6,000 to 7,000 cars. Personally, I would like to wait until Lucid meet the target and able to deliver more than that number before I really take a closer look at Lucid itself. And I remember that they say that they have 37,000 customer reservation to their cars, and now there's only 33 or 34,000. Yeah, I think 34,000 reservations on their cars. So I think their customers are also losing patience on waiting for the cars deliveries. Rivian's is probably doing slightly better than Lucid because it still got the Amazon order for the 100,000 bands. All in all, I think I would say probably you like to wait for all these US car makers prove more about themselves, like starting to generate positive free cash flow before deciding to invest. Because moving forward, some EV makers may go under. Okay. Okay. So this. Okay. Another question. Do you think Hang Seng has bottomed? It seems like the entire China market has bottomed. So Hang Seng has bottomed out, and Shanghai Index has bottomed out. We could also see that Alibaba has rebounded from 60 something dollars to near to $120. So the fundamental news looks great. You see China government not cracking down on the platform companies. You hear the news that Ant Financial may get listed after all. China reopenings, China economy seems recovering. So there are a lot of long-term positive for China. I think this is why most analysts, or I should say all analysts at the moment, are positive on China now. They all say that China are going to outperform US this year. To me, it seems like an easy trade, but maybe too easy for me. Everything just sounds so rosy at the moment. I think I am not able to find faults on investing in China or Hong Kong at this stage, but I would always apply a China discount. Meaning to say, I don't think Hang Seng is going back to the previous high, 30,000 anytime soon. I think 24,000 or 26,000 in the index level is possible, but probably not 30,000. If you have not invested in China stocks, I guess the valuations or prices itself look attractive. It's good to own some China stocks in your portfolio. If you already own some China stocks on its way down, I guess you could be thinking to yourself, you need to make a decision. Do you prefer China over US? Because a lot of the investors nowadays, they are asking whether they should sell some US and move the money to China itself. My thinking is, if you already own some China exposure, you may want to add another 5% in China. But again, do not overexpose yourself in China. The keyword to me is China discount. For example, Apple PE ratio is 22 times. Tencent PE ratio is like 17 times. So Apple PE ratio is now higher than Tencent, but Tencent PE ratio was doing higher than Apple for a period of time before 2021. So typically before 2021, Tencent PE ratio is trending higher than Apple, but not now. So my thinking is all this China technology crackdown has made investors realize that you need to apply a China discount on China companies. Meaning to say the PE ratio for Chinese company will not go back to the previous high anytime soon. Or the PE ratio may not go higher than US technology stocks like before. Okay, I hope I answer your question on that. Okay. We still have some questions. So probably, but we are running out of time. So probably I will answer this question in the YouTube comment sections, or I will answer this under the app chat room function as well. So thank you all for staying, and thank you. Happy New Year to all of you. 恭喜发财, and thank you, and I will see you soon.